Friends, in the last 24 hours, the crown jewel of the Indian economy has been hit by a tidal wave of red. If you have looked at your portfolio today, you know the story. The Nifty IT index hasn't just dipped, it has, cratered. There's a huge dip. TCS, Infosys, Tech Mahindra, Wipro, the giants we thought were too big to fail are now seeing their stock die by 4%, 5%, even 6% in a single session. The TCS, the gold standard of the Indian tech, has actually seen its market cap slip below 10 lakh crore mark for the first time since 2020. But this isn't just another bad day at the office for Dalal Street. This isn't about the interest rates or a bad earning reports. This is about specific terrifying phrase echoing through the boardrooms from Bangalore to New York, and that is Anthropic Shock. Today we are going to take a deep dive. Why is a single AI company in San Francisco causing a bloodbath for 5 million Indian tech workers? Is the traditional outsourcing model officially dead? And most importantly, is the buy the dip movement or the beginning of a permanent decline? What is the Anthropic shock? To understand the crash, you have to understand what happened on January 30th and early February 2026. Anthropic, the Google-backed AI rival to OpenAI, released something called the Claude Cowork. Now we have had AI for a while. We had ChatGPT, but Claude Cowork is different. It's about what we call the agentic AI. Standard AI helps you write an email. Agentic AI is the employee. Anthropic released 11 specific plugins that can autonomously handle legal operations, financial analysis, and market execution. Imagine a legal firm that used to outsource contract review to an Indian IT firm. That process used to take a team of 10 people 2 weeks. Now Claude Agent can log into your company system, find the contract, review them against the compliance laws, and draft an amendment all in minutes for the cost of its software subscription. This is what the Jeffries is calling the end of SaaS function. The market has realized that the AI is no longer just a tool for IT workers. It is becoming a replacement for the very work India has built for, built by the hours for almost 3 decades now. The Nifty IT index is now down over 12% just in, few weeks, 1 or 2 weeks of February in 2026 so far. Why are the big three, TCS, Infosys, and HCL Tech, getting hit so hard? It's because their revenue model is based on the headcount linked growth. For 30 years, the formula was simple: hire more people, bill more hours, make more money. But if an AI agent can do the work of 50 entry-level engineers, that entire formula breaks. The labor arbitrage model, where India's advantage was cheaper human labor, is being disrupted by a silicon arbitrage, where the advantage is cheaper and it is actually cheaper computing power. And this is a double whammy, which is the US macro factors. We will explain this as well. As if the Anthropic shock wasn't enough, we got hit by a double whammy from the US. Yesterday, US released a job data that was actually too good. Unemployment fell to 4.3%. Now, usually that's a good news, but for the stock market, it means the US Federal Reserve is less likely to cut interest rates soon. When interest rates stays high, global companies tighten their belt. They cut discretionary spending, which is exactly the money they use to hire Indian IT firms, for new projects. So the Indian IT is caught in a pincer move. On one side, AI is making their services look old school. On the other side, the high interest rates are making their clients stop spending. It is a perfect storm. Now, let's be fair. Is it game over? Not necessarily. If you listen to the CEOs of TCS or Salil Parekh of Infosys, they will tell you that they are AI first now. They are training hundreds of thousands of employees in generative AI. But there is a catch. The industry is moving from effort-based billing to outcome-based billing. Old ways, which is like pay us for 100 people working on the project, and the new way is comparatively pay us only if the software is finished and working. If the Indian giants can become integrator, people who help global companies set up these AI agents, they survive. But here is a problem that requires fewer people and higher skills. Analysts at Motilal Oswal estimate that 9% to 12% of the industry revenue is at high risk of disappearing in next 3 to 4 years as AI renders legacy software and manual testing redundant. So, what is the verdict? If you are a short-term trader, the technical looks very ugly. The Nifty IT index is an oversold territory, which means we might see a small dead cat bounce or a minor recovery soon, but the broader trend is very negative. If you are a long-term investor, you have to ask yourself one question. Do you believe TCS and Infosys can reinvent themselves faster than AI can replace them? Historically, Indian IT survived 2008 crash, the shift to cloud, the COVID-19 pandemic. They are masters of adaptations basically. But this time, they aren't fighting a recession. They're fighting an evolution. So, what is my take? My take is keep a very close eye on the AI native deal over the next 6 months. If these companies cannot show massive revenue from AI services by mid 2026, the Anthropic shock might become a permanent reality. And now I will like to ask you, what do you think? Is this the end of the IT golden age in India, or just a temporary panic? Drop your thoughts in the comments below. And don't forget to like and subscribe for more deep dives into the intersection of tech and finance. And friends, I will see you in the next one.